Good morning or good morning. So I just wanted to make a video as there's been a lot of discussion, over the last week or two with regards to the fundamentals and the trade tariffs that's been going on. Many of you may be, obviously confused, and the question, that I guess is on everyone's lips is, why is price, I guess, in the short term not reacting to fundamentals? We've had some really good news for the dollar fundamentally, but unfortunately, the if you're in any dollar longs anyway, unfortunately, price is going the other way. So I'm gonna just, I guess, address my thoughts and explain what I think is going on. And really just a reminder of really how complex but simple in a way that fundamentals can be. And when you look at it from the perspective of value and understanding value and not trying to trade really on the lower time frames in terms of, it's okay to trade on lower time frames, but it's really about the location and where you trade. So your perspective really should be anchored more on the higher time frames, the dailies and the weeklies. Then these, I guess, the a week where prices are going against certain positions or in a different direction than what you expect doesn't seem like anything out of the ordinary, and in fact it should be kind of used as an opportunity. So right, so why is short-term price not reacting to fundamentals? Right, so first things first, because obviously there's going to be traders in the group who are at different levels. So I have to kind of go over what I guess my baseline is in terms of what I'm always looking towards when it comes to a filter. So there's a lot of noise in the market. There's a lot of noise in fundamentals and technicals. But what is my North Star? What is my baseline whenever I'm, thinking to myself, what am I filtering out? What noise am I filtering out? And what am I trying to just see at the end of the day? And for me, it's always about interest rates and monetary policy. That's my baseline. So for those of you who and a quick course in interest rates and monetary policy, all roads lead to interest rates. If you've done the course, which you should have done the course, if you haven't already, I definitely advise you to watch the fundamental videos in the Discord area, and take the short course and test. But ultimately, interest rates are what guide a currency's strength and weakness. So a central bank will hold rates, yeah, they will hike rates, yeah, or they will cut rates. Those are usually the three options. Holding rates is basically when they are okay with where everything is in terms of inflation and the economy. If they're hiking rates, it means actually they're trying to appreciate the currency, yeah, right, and fight against rising inflation, right? So appreciate the currency. And when they're cutting rates, they're trying to fight against deflation, which is an appreciating currency. So hiking normally has the effect, or should have the effect, of appreciating the currency, or the central banks are trying to appreciate the currency by hiking rates. And by cutting rates, what they're trying to do is depreciate or devalue the currency, right? Right, that's it. And um, and so ultimately, that is what will always kind of drive currencies. Now, there are situations, as we're seeing right now, where narratives or the focus will shift from the fundamentals to a risk event, right? A risk off event, or another event. It could be COVID, it could be, for example, tariffs right now, it could be a banking crisis, and it's where you have fear, uncertainty, and doubt. For example, a war that's going on, right? And even those that risk off sentiment and that risk off event is actually rooted still in fundamentals, because ultimately the risk off event, whatever it is, will lead and will drive central banks to have to either cut rates, hike rates, based on that risk event's effect upon the economy, right? So if the economy, if a risk event is causing a the economy to maybe collapse, or contract, or go into the a recession, bust, or slump phase, then typically a central bank will try to actually help the economy by cutting rates, right? Lowering interest rates so that money is cheaper, money gets, put into businesses, into consumers' hands, and, to trying to help and stabilize the economy, right? So, it is still interlinked. It's not some separate thing where risk off is just totally separate from fundamentals. Risk off can drive interest rates, and it typically does. But ultimately, the risk off narrative and what the event is, and in this case, it's tariffs, is what is kind of the dominant theme at the moment, the dominant narrative, right? And so we've got a situation where, um, yeah, we're in everything's kind of focused on tariffs. Now, from a fundamental perspective, the dollar really is the king. And I say king really from just a loose perspective, but it's the it's the currency when you compare it on the fundamental analysis spreadsheet with the data that we look at, is number one, right? Now, number one doesn't always mean that it's going to remain number one. It's always going to remain the strongest. But when we compare at the moment, the dollar and the data, when you're looking at, for example, GDP quarter on quarter, and you're looking at, where the United States is 2.3% growth, but you're looking at everyone else, which are closer to zero. The dollar and the US economy is, head and shoulders above other nations, right? But taking this back to what this all means in terms of interest rates, um, what it basically is, when we're looking at the data and understanding interest rates and the effect of interest rates, um, the Federal Reserve are the central bank who are going to be cutting the least, right? So at the moment, their next move, in terms of the probability of a hold or a cut, there's a 98% chance of a hold. The European Central Bank, 94% chance of a cut. Bank of Japan, 84% chance of a hold. Bank of England, 83% chance of a hold. Bank of Canada has got a 51% chance of a hold. The Reserve Bank of Australia, 84% chance of a cut at their next meeting. Reserve Bank of New Zealand, they're looking at least a 50 basis point cut, 71% chance at the moment, and then you've got 95% chance. So ultimately, when it comes to the cuts at the next meeting and the amount of cuts that central banks are expected to make, the Federal Reserve are actually looking to cut the least, in comparison to, for example, something like the New Zealand dollar, right? So over time, again, in the short term, you're not really expecting. I mean, it's all about liquidity, and I'll get into market making, and the institutions and auctions a bit later. But I'm expecting over the medium to long term, the Federal Reserve and the US dollar to strengthen against currencies who are cutting more than they are, right? Because they are actively devaluing the currency, right? So that's really how the fundamentals work. And so, I guess coming, into tariffs and how tariffs affect, and these tariffs and the risk off sentiment are really kind of affecting, the I guess the fundamentals, and specifically really the dollar, is really kind of due to uh, a situation where tariffs, and I guess I have to go to the price chart. So tariffs and the tariff threat was expected to raise inflation, which then would have caused the Federal Reserve to really kind of stop cutting rates, because into October, from around July, I think it was maybe July, there was the rumor that um, actually the central bank, the Federal Reserve, and were cutting rates, right? I say there was a rumor started, but then they actually started to cut rates, and so as they were cutting rates, the US dollar ended up devaluing, right? But then, of course, with Donald Trump leading in certain polls, and the rumor that he could become president, him surviving assassination attempts, etc. The market then started to price in the possibility that tariffs, which really are a way for Donald Trump to kind of get what he thinks anyway, a fair trade deals with other nations. And I guess it's a heavy-handed way of doing it, but I guess there's no other way. But it's his way of trying to get a fair deal with nations. Therefore, he wants to raise prices on American imports from other countries. But the effect of that um, is that it would raise inflation, right? Inflation would go higher. Therefore, the Federal Reserve are less likely to cut rates, therefore devalue. They're not likely to devalue their currency and likely to hold, right? And so the market had kind of priced that into the market. Yeah. So Trump elected plus tariff threat equals higher inflation and less cuts and risk off, which was benefiting the US dollar, right? And again, the dollar rallied due to tariff threats and the rumor plus the data supporting less cuts from the Fed. So as we've come into 2025, we've had positive data out of the US supporting, lower jobs, better economy, lower unemployment, rising employment, non-farms, and rising inflation, or sticky inflation at least. And then we've had, and if you zoom in a little bit, right? And so we've really been on this massive kind of dollar rally, right? And we're expecting pullbacks at the end of the day. We have to expect pullbacks in the rally. And so we had the tariffs and the threat of the tariffs come in, and that was around February the 3rd. And so the tariffs were extended. And when I say tariffs extended, so meaning that tariffs weren't implemented on Canada and Mexico straight away. Now, that basically meant that the market was thinking, okay, well, the threat of tariffs is kind of subsiding, which then would logically mean that if that is the case, then maybe the narrative around higher inflation, the Fed not necessarily having to, to hold rates for longer, but also as well other nations not being as affected and their economies being affected, isn't necessarily as bad as what was first feared, right? So obviously with tariffs, and if Donald Trump was to get into a trade war with countries, then those countries' economies would be affected, and then global growth would end up contracting. And that was really the fear around what Donald Trump was doing with tariffs. And in a risk-off environment, the dollar typically strengthens. So you had really lots of things going on until Donald Trump then said and turned around and said, well, in fact, he's going to extend those tariffs, right? He's not going to impose them and implement them straight away on countries. And so what that had the effect of weakening the dollar for the reasons of other countries are probably going to be doing better, and also as well maybe inflation they had potentially priced in right into the market in late 2024, early 2025, it may not come to fruition. So then the dollar has to be, revalued. And as we've got these reciprocal tariffs to start in April, again, another kind of delay in um in the tariff and the trade war, more risk on is coming into the market. And risk on meaning that um there's obviously investors feel a lot better about investing in higher yielding in assets, right? Like the stock market, because they're feeling, okay, well, things aren't as bad as what is being projected, or may not be as bad as what is being projected. So money's coming out of the dollar and into other, countries and other asset classes. But does that mean that the dollar is a sell? Right? Does that mean that the dollar is a sell? Now, um, when trading risk off, right, and trading tariffs or any kind of risk off environment, and I've put in here in brackets tactical, and what that really means is that you can have really two approaches to trading, right? So my baseline is always to keep in mind what will be the effects on interest rates. What is the central bank doing with interest rates? And so, regardless of what happens when it comes to a risk off event, I'm always considering interest rates and monetary policy. Now, from a tactical perspective, you can trade risk off, but it can be very difficult depending upon what the situation is. So, for example, with tariffs, it's a difficult one because ultimately you're trading Donald Trump's announcements. So every day he makes any kind of announcement, or any week he makes an announcement, if it doesn't go your way, then ultimately, you're gonna, end up losing the trade, right? So yes, you can kind of jump in and jump out and try to guess as to what Donald Trump may say or what he may not say. Now, for me, that's more of a riskier way to trade. I'm not really a fan of trading in that way and trading risk off in that way. Um, so it can be tactical. And whenever you see, for example, some articles from banks and they say I'm tactically long and I'm tactically short, it means that they're trying to take advantage of maybe some short-term moves. But ultimately, they will, if they're saying that they're tactically short, it means that they're overall long, but they may want to take advantage of some short-term sentiment or some short-term, risk event. But tariffs for me would come into that tactical way of trading. But for me, it's not for me. It may be for you, but it's not for me. Ultimately, when the dust settles and things return back to normal, then, as it always does, interest rates and monetary policy will always then return to be the dominant theme. It is, I would say, I don't know, a high percentage of the time. I don't want to say 80%, 90% of the time. I don't want to say that, but the majority of the time, when there's no risk of sentiment and there's no risk of events that are really affecting the market, or at least affecting interest rates, and it's solely based on, whatever risk event that is, then ultimately things will return back to interest rates. And if tariffs are affecting interest rates, then fine. I will still trade that risk off event if I know that the risk off event is going to affect interest rates. But in this in the tariff situation, I don't believe that it's affecting rates to a great deal, or it is yet to be seen that it's affecting the US dollar and the Federal Reserve's decision on whether they're going to hold rates or cut rates. Now, as a bit of a sidebar, you've got Donald Trump who does want lower rates, and that will be, as that comes into a bit more focus, then I will possibly look to see if that is a tradable event where, maybe Donald Trump starts to put pressure on the Federal Reserve and whatever that, comes of that. But at the moment, um, I'm again more focused on what the interest rates and what the central bank is doing, and this is how I filter out any noise or what I consider to be noise. Now, the opportunity arises. Yeah, trading opportunities arise. They can be every day, right? You can have a trading opportunity every day, but for me, the best opportunities arise when price and value are not aligned. So what do I mean by that? Is when you have something, an asset that is cheap, right? So there's a saying that goes, the market can remain uh, irrational for longer than you can remain solvent. So what that's kind of referring to is, um, is where you have, for example, a market that is just keeps making higher highs. So let's say, for example, the stock market right now. There's many traders and investors that believe that the stock market, and have believed that the stock market, the S&P, has been overvalued for a couple of years now. And so you know that there are many traders that would have been trying to short the S&P and have been trying to short the S&P for a number of years now, but it just keeps going higher. And they're scratching their heads and saying, this is absolutely irrational, right? This is absolutely nonsense. The S&P shouldn't be as high as it is, blah 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 blah, right? So that's basically what the saying is. It's saying that the market can remain irrational for longer than you can remain solvent, meaning that, if you've been shorting the S&P, then you've definitely been stopped out and maybe have blown an account or two. But what that has to do with, the opportunity arises when price and value are not aligned, is really understanding value. And so, unlike really the stock market, when you're trading Forex, you're trading a currency in pairs. So you're trading, for example, the EU. Yeah. So the EU, right? Now, um, just because the dollar is, in terms of price, is going down, yeah, doesn't mean that the euro is, strong, right? Doesn't mean that the euro is strong. Is the euro fundamentally, right, in terms of interest rates, or is the ECB looking to hike rates, right? And the Fed are looking to cut rates. Well, no, that's not really the case. If anything, the Fed are looking to cut by something like maybe 30, 35 basis points at the moment. I think that's what it is, or at least one cut this year is being priced in, whereas the ECB are looking to cut by something like 90 basis points, and there's maybe about four cuts coming. So you would think that at the moment, price, on the EU, right, is going higher, right? If you're looking at the chart, euro dollar is going higher currently, and I'm recording this on February the 14th, 2025. And so traders now are going, well, I should be a buyer, right? Because price is telling me to, to go long. But ultimately, value, when it comes to value of the dollar, yeah, you would think that, in fact, fundamentally, the dollar is the buy, yeah, and the euro should be the sell, yeah. So when price and value are not aligned, there is the opportunity to short the market. That's where I'm looking at, and that's my belief. Again, traders may, believe something different. They may believe in buying highs and that price action is king, and all you need to know is what the price chart is telling you, and ignore, the fundamentals, schmundamentals, and all that kind of stuff. It's up to, each to their own. But ultimately, if you are, looking at understanding value and fundamentals, and what really drives price over the medium to long term, meaning, next, couple of months to maybe, 6 months to a year, then ultimately, you have to really understand what's going on with the fundamentals, right? Because that is what is going to push price. And that's, I can go on the price chart and prove it time and time and time and time and time again. But as we've actually proved with the dollar chart, right, that I showed earlier, right, in terms of fundamentals, and Donald Trump, and the buying the rumor, etc., right? That was a pure fundamental play. It wasn't because of any kind of Elliott wave theory. It was basically investors buying the dollar based on what they thought the dollar was worth in the future, based on tariff threats, rising inflation, the Fed changing course with their monetary policy. So opportunities arise when price and value are not aligned. Yeah, that's really where we are now. The key question is, of course, is where, right? Where do I sell or where do I buy? Do I buy here, right? Or sorry, do I sell here or do I buy the dollar here? In terms of you buying the dollar against the euro, then of course you're going short, or there could be another level higher, right? Where, um, it could be support and resistance or supply zone. Is it there or is it going to be up top here? Nobody actually knows, right? Which is the reason why we just risk, a small position of our accounts to see whether that level is going to work or whether that level is going to work, right? That's where the technical analysis comes in terms of entries and identifying where the market was buying and selling previously, whatever your technical strategy is, right? But ultimately, um, you know, uh, it's really about identifying potential value on a price chart, whether and however you do that, right? And that when the opportunity arises when price and value are not aligned. And so um, it's also important to understand auctions institutions uh, in terms of value and market makers and liquidity, right? So um, I do again have a channel in the Discord group that kind of goes over identifying ranging markets and auctions. But to kind of summarize, is that really institutions are looking for are looking to buy a value, right? So when you go to, for example, the COT report, and you're looking at asset managers, institutional, and you're looking at leverage funds, for example, we all know, or if you're looking at COT, and if you've never looked at COT before, basically, asset managers, institutional, are basically the large funds, massive, money, and they're basically the longer term trend, right? And then you've got leverage funds, which are like hedge funds, and they're looking for longs and shorts. So they can go long and short, and they're more of the tactical side of things, right? These guys are more of the fundamental side, and they can't enter and exit trades in the same way that, for example, retail traders can and leverage funds can, because of their position sizes. So when they are long or when they are short a currency, or an asset, pretty much they kind of have to do all their due diligence, and they have to be really sure that over the next 3, 6, 9, 12 months, that that asset is going to continue to appreciate or devalue, right? So when it comes to understanding institutions and how they actually enter and exit trades, they can't they're trying to avoid slippage, and slippage is basically just a way of getting of avoiding getting in and at a disadvantaged price. And I don't necessarily want to have to go into what slippage is. Again, if you go to the stop hunting course, I explain slippage in that course. But ultimately, institutions are looking at overall value. They're looking into the future, and they're saying, look, we have to make commitments and large commitments to buying and selling, right? And once they're long on an asset, they typically stay long for quite a while. Now, it's the market makers who provide liquidity in the short term for institutions. Market makers don't care about the fundamentals. They're just there to make money and provide liquidity for institutions. And that's basically what the market is. The market is for institutions, right, to make money, and for market makers to provide that liquidity and make money by providing that liquidity, right? So it's a relationship that they have. It's not for speculation, really. It's really a business. It's really an auction. And so when we talk about, and when I mention auctions, the business that the institutions have to conduct in terms of buying and selling, yeah, can take place over days, weeks, and months. And as I said, with the COT report, you've got institution leverage funds who are short-term traders, and sometimes, of course, long-term traders, but mainly on the short to medium-term tactical approach. Whereas you have the large asset institutional managers who are on a longer term bias, right? And so the institutions, it can take them, weeks or maybe months to basically fill a position. If they want to, buy one, or 10 billion pounds worth of dollars, because they see, for example, whatever fundamental down around the corner, then it's going to take them, it could take them a few months. And it's not necessarily, and that may be one institution. There's hundreds of institutions, possibly thousands of institutions all over the world who may be trying to get in on that same idea. So market makers, there's not enough liquidity obviously in the market to facilitate all the buying all at once, right? So market makers over a certain period of time have to allow uh, or say allow, but they have to fill those orders, right? And that's why you get what is known as really an auction, where you have, it's been described as, the accumulation and distribution phase. But however you describe it, it's an auction, and it's where basically institutions can buy and sell, right, and accumulate before prices either move to the upside or prices move to the downside, right? So, and then when they move to the downside, then prices will find another auction, right? Now an auction also is telling us the value of, said currency or asset. Right now, an asset price isn't really, or shouldn't necessarily be judged just by, where it is at its current price right now. Different institutions will have different valuations of what they think, a currency is worth. So let's say, for example, um, uh, uh, Goldman Sachs may say that they feel that the euro dollar might be, with everything that we know about fundamentals, might be expensive around, say, 107. Right, 107 is definitely, I'm not buying the euro against the dollar at 107, and that's Goldman Sachs, right? Let's say, for example, HSBC might say, well, we think that it's 106. Yeah. But then Goldman Sachs may say, all right, then, well, in fact, I think the dollar or the euro is an absolute bargain at, let's say, for example, 101, right? Right? They might say 101, yeah, is the absolute, bargain price down here. And let's say, for example, Wells Fargo might say, we think, 10, or we might say parity might be where the euro is an absolute bargain, right? And the dollar is expensive. But there's a range of prices, yeah, right, where different institutions will probably say, and they will all be in some sort of alignment, or typically the majority of them will be in some sort of alignment when it comes to their pricing, right? So of course they're never going to agree 100%, and but there will be like an alignment as to where they think an exchange rate or an asset class is considered expensive, considered cheap, and what is considered maybe, fair value, right? 104, to maybe 103 might be considered fair value. Yeah. And that again is illustrated with um some, where you can see it in certain banks, right? In certain bank forecasts. Now, Mizuho released one, and you can see here where they have dealers, right? And their dealers, right, are basically saying that the ones that are bullish on the dollar, right, and there are 10 bulls, 10 out of 16 bulls, and 6 are bearish. They think that the dollar yen, for example, the 158 would be considered on the expensive end, and 15250 would be considered cheap, right? And the bears would say a great place to probably look to you know uh, buy and sell, right, would be 151 to 157. So they're saying, so you can see where the ranges are, and where the auction is, and where, the extremes are. And again, it kind of breaks down. For example, Miyachi says 15950 to 153s, and he'll say why, for example, the fundamental reasons why. Kawhi, who is a bull, will say 15850 is what he would say is the limit of the move, and 15250 as well, right? Or 15350, 15250. So different dealers, different banks, different institutions have different perspectives, but ultimately it's normally within the range, right? It's normally within that range of prices. And so why is really that important? Because if this is, for example, I don't know, a 600 pip range, right? 600 pip range. Yeah. And let's say, for example, this is the dollar index, or this is the euro dollar. And let's say, for example, this is, I don't know, 10, let's just say this is 106. And this is, parity, right? This is $1. Um, let's say price is currently at, let's say, for example, 105s, right? We're at 105s right now. If we're at 105, yeah, and we've been going higher, and let's say, for example, from 104 to maybe 105, now price has moved 100 pips to a day trader who is used to having maybe maybe 10 pip stop, 15 pip stop, 20 pip stop. A price move of 100 pips is like, oh my days, what has happened? Why is the dollar weakening? What's happening? Blah 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 blah. Leon said this, Leon said that, fundamentals don't work, blah 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 blah. But really, that's not the way to kind of, well, that's not the approach that I take. Yeah, you can, again, see it in the way that you want to see it, but the approach that I take is to understand where the banks and the institutions are saying where is expensive or where is cheap. Yeah, where is premium and where is discount prices. And so prices moving 100 or 200 pips against my fundamental position is not a big deal. Yes, if I'm in a trade and I might lose that trade, right, then okay, fine, I lose that trade. It is what it is. But ultimately, if this is considered a bargain price for the US dollar against the euro, right, somewhere up in these levels right here, right, then I'm going to look for a trade within this area. I don't care whether prices have moved 100 or 200 pips to the upside. All I'm looking for is this is a buy for the dollar against the euro, because fundamentally, when it comes to interest rates, the dollar should be the buy. Now, am I going to get it right 100% of the time? No, but when I do get it right, guess what? If I'm correct about this, then I have at least 5, 6, 700 pips potential of downside, right? So I might lose 50 pips here, 40 pips there, whatever, a trade to or free here, right? But ultimately, it doesn't matter about win rates if when you do win, you're winning big on the downside, if the fundamentals, and should the fundamentals come through over the medium to long term. Short term price, yeah, short term price doesn't really matter to me. Yes, short term price matters to lower time frame traders. There's lots of algorithms, there's hedge funds, the tactical side of things. Yep, absolutely, right? But I'm not panicked. And if you're a fundamental trader and looking at the higher time frames like the dailies and the weeklies, then you really shouldn't be panicked about whether prices are going against you. And like I said, it's not nice if you've entered into a trade and then the market has said, well, we don't think that that's a bargain for the dollar at the moment, because ultimately tariffs are being priced out. All right, we think the dollar is maybe a bargain a little bit higher, and it might be a little bit higher than that. Nobody knows. But ultimately, if the fundamentals haven't changed, if monetary policy, if tariffs are not changing central banks' thinking on interest rates and monetary policy and what they're likely to do, yeah, with cutting rates, holding rates, hiking rates, then ultimately you should just look for long trades or short trades on, say long trades on the dollar, or maybe short trades on the euro, or whatever currency it is that you're trading, because ultimately the market is really just pricing in and out future value, but based on obviously what is known today and what is known currently in the market. So there was a point I wanted to make about market pricing in and out, and now I just can't remember it. I did write it, I did put it down here, and now I'm just can't even think of what it was now. But anyways, I think I've pretty much covered um everything that I wanted to cover. So At the end of the day, it's just really about understanding the bigger picture when it comes to, your fundamental bias and trying not to get drawn into the noise and identifying value, right? If nothing has changed fundamentally, then ultimately any pullbacks on the dollar, right, that we're seeing at the moment could be either a stop hunt or it could be, just another level if prices do devalue down into another demand zone. That would be the buying opportunity. And when you actually look at this from a technical perspective and the dollar from a technical perspective, we haven't really pulled back to any kind of fair value between this high here and the lows of the beginning of October, where the dollar originally made its kind of this its run. um the On the equally weighted dollar index, you've pretty much fair value is we're approaching fair value, or at least a pullback, right? So this is to be expected in many ways. And um, I guess maybe a bit more of a conspiracy theorist side of me thinks that ultimately the narrative of tariffs being delayed is being used by certain institutions to kind of either exit positions or to manufacture liquidity by the market makers, and also as well to allow institutions to buy more dollars, because ultimately once the tariffs are kind of sorted out and we start to go back to looking at what the difference is between divergences in monetary policy, then the dollar currently at the moment, as long as of course they are still great on GDP, interest rates, inflation, and various other data points, the dollar should still continue to be a buy. So, yeah, that's where I am ultimately with, and hopefully explaining everything and my thinking and how I really kind of approach a situation like this. Not only just tariffs, but every single risk off event. Hope that helps, and take care.